Good morning, options traders, and happy Wednesday, everyone. I received a really good question from one of the traders earlier in the week asking about trading fees and rebates. And you see these terms a lot when you're dealing with ECNs or with alternative trading systems. And it can be a little confusing to determine if your order is going to potentially receive a rebate or if you're going to be charged a fee. So for starters, what are ECNs? Well, these are electronic communication networks. They're just simply links of computerized systems that match buyers and sellers. And you're going to find some platforms out there, some brokers that are called direct market access platforms. And so if you have one of these DMAs, you can tap directly into an ECN and you're just trading amongst other traders. And you're therefore bypassing the brokerage firms and the market makers. Some of these ECNs will actually register with the SEC and with FINRA, the Financial Industry Regulatory Authority, and they can actually become what's called an alternative trading system or an ATS. So these really do act like their own exchanges. So a fairly recent example that actually has alternative trading systems in its name was BATS. It stood for Better Alternative Trading System, and it was actually purchased by the Chicago Board Options Exchange in 2017. But here's the point, and this is what this person's question was all about, that these systems will offer rebates for providing liquidity, and they will charge you fees for removing liquidity. So what exactly does it mean to provide or remove, or sometimes as they say, taking liquidity? And that's going to be the main point of this video. But the fees, first of all, aren't terribly huge, but they're also not insignificant either. You might see for shares, let's say 0.0015, which amounts to $1.50 per 1,000 shares. So they will credit this back to you if you are adding or providing liquidity, but they will subtract it if you were removing liquidity. And they will have similar fee schedules for the options. So again, the idea is how can we determine if you are providing or removing liquidity? Well, to do that, we have to go back to some of the basics about market versus limit orders. Remember that a market order guarantees the fill, but not the price, while a limit order guarantees the price, but not the fill. So when you're trading through these ECNs, market orders always remove liquidity because you're actually just taking orders from the queue. You're not adding orders to the liquidity pool. And because a market order is guaranteed to fill, those are always going to remove liquidity. So that's pretty easy to understand, but where it gets tricky is that the limit orders might add, but they might remove liquidity. And to understand whether you're going to be adding or removing liquidity, you have to understand limit orders versus marketable limit orders. This is really the big trick right here. So let's start with a quick review of a basic limit order first. Let's say we have our quote, maybe for an option, bid 5, offered at 550. So let's say that you place a limit order, and so you're saying, let's say, sell 10 contracts somewhere above 5, anywhere above the current bid. This is a limit order because you're selling away from the current market. You're trying to get more than the current market prices. And this is what most people understand to be a limit order. So if I said I'm going to sell 10 contracts for 505 or 510, anything above the current bid, that's a straight up limit order. On the other hand, if you place an order to buy below the asking price, let's say anywhere below 550, down in here, that's also a limit order. So I'm typing up my order, buy 10 contracts for 540 or 530 or 4 or 3, anything below the current asking price. That's a limit order because you're trying to buy below the current market. So again, I think most traders understand limit orders, but the thing that they don't get are what are called marketable limits. So what are these? Well, a marketable limit is a limit order, but it's going to act more like a market order. So again, let's say that these are the quotes, and you place an order to buy at a limit of 550 or higher. So you're matching that asking price or higher. So I type up an order, buy 10 contracts for 550, or buy 10 contracts for 555 or 560 or 570. Those are technically what are called or better orders. You're trying to buy for something above the current market. Now you might think, well, why would you do that? Well, traders do it because they might see the price running, and as soon as they see, let's say, the price at 550 while they're typing it up, it goes to 560. So rather than chasing it, they just say, okay, place an order for 580. And that allows a little bit of wiggle room if the prices are moving, but then they know that they're not going to get filled above that limit. But because it's virtually guaranteed to be acting like a market order, these are what are called marketable limits. You're saying, yes, I'm willing to buy at the asking price or a price even higher. So that's going to fill immediately. So that's where the word marketable is coming in. Yeah, it's a limit order, but it's going to act like a market order. We can do the same thing for the sell side. Let's say you sell at a limit at 5 at the current bid or less. So you say, okay, I'm willing to sell right here at the current bid of 5, but I'm also willing to sell below. Same idea in reverse. Sell my 10 contracts at a limit of 490. That's a marketable limit because it's probably going to fill right now at the current bid. But just in case it doesn't, I allow for, in this case, another 10 cents for it to slip. But the idea is because I'm willing to sell below the current market, it's going to fill immediately. And so it's acting like a market order. So once you understand the difference between a true limit order versus a marketable limit order, now it should make more sense whether you're adding or removing liquidity. So if you have your buy orders below the current bid, you're buying away from the current market, you are adding liquidity and you're going to receive rebates. If you are placing sell orders above the current market, you are also adding to liquidity. You're not going to get filled right now, so you're adding to this pool of potential orders. And then finally, buy and sell orders in between the bid and the offer will also add liquidity because they're limit orders. Yeah, you'll tighten up the bid-ask spread, but they're still limit orders. And so you will be receiving rebates for adding liquidity. However, if you place a sell order below the current bid, you're removing liquidity because this is a marketable limit. It's going to get filled immediately. If you place a sell order at the current bid, you will also be charged a fee. That is removing liquidity. You're matching that bid, so you're going to get filled. If you place a buy order at the current asking price, you are removing liquidity because you're taking orders out of that queue. And then also if you place buy orders above the current asking price, those are marketable limit orders, and you will also be charged a fee for removing liquidity. So yes, I know it can be confusing, but the simplest way to break this down is to just understand whether the order is going to fill immediately with a market order, in which case you're going to be charged a fee, or with a marketable limit, because that's effectively a market order. And then all of the others you would be receiving rebates for. So for any of you who might be trading on ECNs or alternative trading systems, hopefully this helps you to understand when you see the terminology about being charged fees for adding or removing liquidity. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.